Please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Welcome back. Well, a lot of earnings to reckon with. Coal India's Q1 earnings missed street estimates. We have Nigel here with us to tell us more.
Well, in terms of Coal India's numbers, lower e-auction volumes really spoiled the party for all those that were bullish on Coal India. In terms of the numbers, they look good on a year-on-year basis, but not as good as what the street was working with. Top-line growth of around 26%, that was more or less in line or a tad bit better than what the street was working with. In terms of the offtake, we already had those numbers with us. So the sales volume growth was around 11%. The problem is in terms of that mix out there. So the FSC sales volumes growth was phenomenal. That came in at around 130 million tons odd. So that's a growth of around 21%. But the big problem was that the e-auction sales volumes came in sub 20 million tons. Remember, most of the street was working with a number of around 26 to around 28 million tons odd. And that's really where the big miss was. The realization jumped up by around 10%. But if the e-auction sales were higher, you would have had higher jump in terms of realizations. And lower realizations in comparison to what the street was working with further came down to the margins, because the street was working with a margin of around 26%. These margins came in closer towards 22%, so lower realizations in comparison to what was expected. And also the employee cost at around 9,500 crores. That included one-off of around 200 to around 300 crores odd. And that's what led to a bit of a miss on the margins front. The profit number, owing to a weaker operational performance, did come in at around 3,800 crores. The street was working with a number in excess of around 4,100 crores odd.
Okay, and Nigel, what about Tata Steel?
Well, in terms of Tata Steel, let me run you through the key expectations first and what are the consolidated numbers you're looking at. Top line growth of around 21%, margins at around 19% odd, and net profit number of around 2,500 crores. Now, I'll tell you what, these are the least important numbers. For Tata Steel, you're looking at the geographic breakup. So let's start off with the India operations. Remember, we already have the sales volumes with us, the provisional number. So that's come in high by around 8% for the India operations. But importantly, the street looks at the EBITDA per ton. Our poll threw up a number of around 17,500 rupees per ton. That's in terms of Tata Steel's domestic EBITDA per ton. What helps them out here? You have operating leverage playing out because of higher sales volumes. Remember, realizations as well have jumped up on a year-on-year basis. And Tata Steel, they have been focusing on value-added products, be it the automotive segment or even the branded products segment. In terms of their domestic operations, remember, they are partly integrated. So close to around 40% of their coking coal requirement comes in from captive sources, while in terms of iron ore, they're virtually, totally integrated. But moving to the European operations, well, on a year-on-year basis, we could see some compression in terms of an EBITDA per ton. We're working with a number of around $70 on a per ton basis. Sales volumes, they're more or less flattish at around 2.43 million tons. What doesn't really work in their favor? Steel spreads. That's the difference between your selling price and your input cost. That is expected to get compressed a tad bit, and we'll have to see whether or not they had some high-cost coking coal inventory that could reflect in this first quarter. Southeast Asia, we already have the sales volumes numbers. That's coming at around 600,000 out.
Okay, Nigel, thanks very much for that. So that's on Tata Steel and what we can expect. But State Bank of India reported its numbers during market hours on Friday. But obviously, the brokerages have had the weekend to sift through the numbers and to tell us what they make of it. And Abhishek is here to apprise us of that. Abhishek, over to you.
Good morning, Ekta. So what the brokerages are saying that slippages outside the watch list remains elevated, and that came in around 11,000 crore for this quarter, and that is not gone down well. But they have said that the strong recovery that the bank has shown in this quarter will be sustainable ahead due to NCLT resolutions that will happen going ahead. However, loan growth remains weak, and that is why you see many of the brokerages actually cutting down their FY19 estimates. The likes of Macquarie cutting their estimate by 24%. Deutsche Bank cutting their estimate by 14%, Nomura by 85 to 90% for FY19 alone. However, they maintain the bullish call except Macquarie. Everyone has a buy or overweight rating. Kotak target price at 370. Macquarie, the lean one, being at 281. Deutsche Bank 365. Nomura, they have raised their target price to 360 from 350, and Morgan Stanley with a target price of 340. Back to you.
Okay, all right, Abhishek, thanks very much for that. Well, let's talk about Glen Mark as well. Glen Mark will be in focus on account of its numbers, which were released on Friday evening. So it was actually a very interesting set of numbers. You know, the revenue declined more than what was anticipated. So the revenue was down around 8.4% to 2,665 odd crores. And we had that versus an estimated 1.5% decline. The margins came in at 16%, which was in line with expectations. So that was at 16% versus 24.4%. And the profit was down around 30% this quarter. Now, remember that the call is going to take place at 8:30 a.m. this morning. So we're going to get more details. What stood out was that the U.S. business, as expected, declined over 30% on a year-on-year basis. And that was because of a high base impact. But India, which was expected to grow in double digits, only grew around 7.5 to 7.6%. And that might have been a little bit of a chink in the armor. Separately, the company has collaborated with PE firm True North on the orthopedic and pain management business of Glen Mark within India. So within the domestic business, this entire business is valued at 650 odd crores. It's a little over 1.5% in terms of total sales contribution for Glen Mark. So we need more details on this particular transaction. So we'll probably try and get more details from the conference call, and that's one of the things that the stock will react to today. But let's move on to the OMC space then. IOC reported what was a big beat on margins, but the revenue came in below street expectations. Sonal is here with a detailed review. Sonal.
Good morning, Ekta. Well, you rightly said the margins, they were a big beat and revenue were below estimates, but majorly margins were higher on the higher side because of higher inventory gains. If I run you through the numbers, revenue went up by 10%, lower than the poll, but EBITDA, that went up by 14% at 12,000 crores versus a poll of 10,000 crores. Margins came in at 9.7%, that is a 30 basis points increase sequentially versus a poll of 8%. All this leading to a profit growth of around 31%. Refining was one segment that fared better. That was because of lower operating expenditure. Even marketing did very well this time around. But in terms of core GRMs, they came in at $2.6 per barrel. That compares with $5 per barrel sequentially and $6.7 per barrel on a YOY basis. The reported GRMs, they came in at $10.21 per barrel. That specifies how much the inventory gain is. They are around $8 per barrel. Refinery throughput, that increased 3% on a sequential basis. That is because that Paradeep refinery, which was shut for maintenance, has come back to working. Domestic product sales and the exports, they also increased sequentially and on a YOY basis. That is because the company's market share in petrol and diesel products, that increased. So that is something that is good for the company. Bank of America has a buy rating with a target price of 210 rupees. They say that the Q1 was supported by higher inventory gains. However, there is a significant increase in core run rate that is needed. Jefferies, that has increased the target price with a buy rating. They think that the beat was driven by better core performance in both refining and marketing, and petchem and pipeline, they were largely in line, but let's see how the stock reacts today.
All right, Sonal, thanks a lot for that. Meanwhile, Amara Raja's first quarter operational earnings were below estimates, but the revenue figure came in strong. Sonia's here with the key highlights from this quarter. Sonia, mixed set of numbers?
Yes, it was a mixed bag for Amara Raja batteries. In fact, as you rightly mentioned, the top line growth was solid, coming in at almost 19%. That's because both the automotive and the industrial battery segment did quite well. They don't really give the volume figures, but they have said in their presentation that the automotive battery segment saw a very strong growth. In fact, they saw market share gains as well in two of their brands, Amaron and PowerZone. The industrial battery segment was good, except the telecom segment, which was sluggish because the market environment was weak. But barring the telecom segment, there was double-digit growth in the industry battery segment as well. But that's about the top line. The key disappointment really comes on the margin front. That's because they've not been able to manage raw material cost pressures well. They've had higher other expenses as well. Employee expenses have gone up. In fact, raw material costs as a percentage of sales have risen to 71.5% this time around versus 62.7% year-on-year and 68.7% quarter-on-quarter. Other expenses for them have also gone up 15% year-on-year. So clearly competition is hotting up. We've seen the way Exide has been gaining market share as well in certain segments. So there doesn't seem to be as much pricing power that Amara Raja has now compared to what it had about a year ago. So that's the bit of disappointment. The margins coming in at 12.3%, falling 50 basis points year-on-year and lower than what the street estimated as well. Now remember, the stock has run up quite a bit. It's gone up 20% since the lows in June. So I expect some profit taking today.
Okay, all right, Sonia, thanks very much for that. Well, we need to take a break now, but up next, India's IIP data, India's industrial production growth accelerated to a 4-month high of 7% in June. More details once more.
Welcome back. Now on Friday, post-markets, there was some cheer on the macroeconomic front. The factory output in June has hit a 4-month high of 7%. This compares with a decline of about 0.3% in the same month last year. The index of industrial production, or IIP as we more commonly know it as, benefited from a low base effect when compared to last year. Lata is here with the key details. Lata, 7% 4-month high. Should we cheer, or is this just of a low base?
Well, it is definitely off a low base, and we all know all the first quarter results have had the same advantage of low base, because last year same time there was a lot of disruption because of GST. So there is the low base, but nevertheless, the expectation on the street was 6%, as Ekta's poll had indicated, and compared to that, it's come at 7%. So it is better even than expectations. And of course, what the stock markets would want to hear is about, of course, electricity growth has been very good at 8.5%, but capital goods growth at 9.6%. And actually, if you take now April, May, June, the average capital goods growth is 9.1%. So that definitely means that at least some replacement demand has come in and capex has picked up. Consumer durables growth, a very sturdy 13.1%. But what will puzzle you is the consumer non-durables, which is actually FMCG non-durables. And that is 0.5%. And for April, May, June, it is 0.5%. So all that we talk about in terms of volume growth is not really translating into outside listed stocks, or so it seems.
Okay, all right, Lata, thanks very much for that. We have the CPI data, which will be out this evening as well, where the core CPI would again be the key focus. But let's move on then. Castrol India delivered what was a good result for the quarter gone by. Utkarsh Chaturvedi caught up with Omer Dorman, the MD of Castrol, and began by asking him if the growth rate is sustainable given the volume growth the company is seeing.
10 quarters of successive growth, apart from the Q2, the GST transition quarter. And it's interesting because when we started our growth journey in 2016, the exact questions were asked, saying that, is it sustainable? And 10 quarters on, we're still being asked the same question. And we really bid on the growth of India. And what we've been seeing in the last 2-3 years is there's huge growth in two-wheeler and four-wheeler personal mobility space. And what we're seeing also this year in 2018 is there's been a huge growth in commercial space. Yeah. So just standing still, you need to grow. Yeah. But of course that's not enough, because you need to also grow your market share. And in the last 10 quarters, we've been really focusing on volume growth. This year we're really happy with the growth, because the 80% of the growth is coming from the interventions that we made in the last 9 months, which are new products that we've been introducing. And the products are not only personal mobility, but we have also products that we introduced into commercial space. That means we've seen where the market has been moving and the trend. So based on market insight and our differentiated technology, that means that we're serving the market and the consumers are picking up what we're serving.
So you think that this kind of growth numbers will sustain, say, for the next 2 to 3 years?
We definitely hope so, because our growth strategy, looking at the next 5 years, we're saying that the market is going to grow, and we're going to grow ahead of the market. That's what we're planning.
So if you look at 2020, now that's an important juncture in the auto industry, given the BS6 norms will come into play. So prior to 2020, there is expected to be a lot of pre-buying, especially in the commercial space. But post that, do you expect a certain dip for some time? And what is the expectation on pre-buying before 2020?
So that may be the case. I mean, that happened also during the BS4 transition. So there may be some dips post the transition. But looking at the long-term trend, I mean, we'll always have these cyclical trends, but a long-term trend looks healthy. And I think we are moving in the right direction in terms of moving towards a premium, low-emission standard. And that's where Castrol has been betting on. And that's the market that we've been developing, the premium side. So that's why we're hopeful that the market will come towards us in the next 5 to 10 years.
Welcome back. Well, let's go across to Manisha Gupta now, who joins in with an update on all what's taking place in the commodity currency space. Manisha, a lot to track this morning.
Oh, absolutely. Thank you so much. Yes. Starting with the Turkish Lira itself, and by last week, of course, we saw record lows onto that one. That's exactly how we've started this week as well. We have seen an all-time low of 7.24 on the Turkish Lira, and that has led to many other currencies also joining in the lower side. So you have the euro, which is holding still around one-year lows. There is a safe haven buying, though, in other currencies like the US dollar, the Swiss franc, the Japanese yen. These currencies are doing better. Almost everything, other currencies, whether it's emerging markets or high-yielding currencies, are trading on the weaker side today. That is one of the reasons that you also have seen commodity prices come under pressure. If you look at the metal space, that has seen a bit of a decline. The crude oil prices on the other side have seen some support. That's because the IEA data suggests that the demand estimates for 2019 are seen on the stronger side. If you look at the US dollar, that one also, if you look at the US drilling rigs, that is, we have seen a hike of 10 rigs into that one to a total of 869. So that really isn't weighing onto the markets right now because the demand estimates are on the stronger side. Also, because of the US-Iran sanctions, markets are working out with a calculation that nearly 1 to 1.5 million barrels per day could go offline starting the third quarter of this calendar year itself. And maybe other producers may not be able to fill in that gap. And with the demand estimates on the higher side, you are seeing that support come back in prices. So after nearly 1.5% gains on Friday, we have seen some follow-through buying as far as the crude oil prices are concerned.
All right, Manisha, thanks a lot for that. Follow-through buying in crude prices, but not so much in the index futures space, primarily because of the weakness that we saw on Friday's trading session. The Nifty snapped a 5-day winning streak. In the index futures, through the week, the key data point that stood out was the fact that the August futures premium, that one thinned from about 29 points to about 9.75 points. Will be very interesting to see whether this expands going forward or not. We saw some sale of around 200 crores by the FIIs in index futures on Friday. Nothing big to worry because they're still long by about 57%. The one data point that caught my eye was the selling that we saw in index calls, and that is the first time that we saw in all of last week, perhaps all of last 2 weeks, where the FIIs actually went ahead and sold index calls. That's telling you that maybe there is a bit of a speed bump at that 11,500 mark. The Nifty put call ratio still at 1.75, lower than 1.8 that we saw on Friday's trading session, but above that 1.7 mark, which is still elevated. 11,500 call continues to see some writing. 11,350 put on the lower end sees some support. So that is the range that the street perhaps is working with. 3 stocks I will be watching out for. The first one, Jet Airways, back in F&O ban after it exited F&O ban on Friday and lost on Friday. And a lot of long positions added on both PVR and Berger Paints, which were buzzing on Friday.
Okay, all right, Mangalam. Well, that's on the F&O space, but on to the bad asset resolution space. Nisha Podar caught up with Zia Modi of AZB and Partners and began by asking her how she assesses the distressed assets resolution area and whether she considers it a success so far.
So, frankly, I'm quite optimistic and I'm personally very pleased. If you had seen this sort of process play out in the span of 2-3 years earlier, you would have been aghast because you never thought that the system would lend itself to such relative speed, if you like. Today, if you look at it, with the push of the government and the way the RBI has basically indicated its point of view, banks have come, offered up their balance sheets to be provisioned. I think in some cases been surprised at how the auctions have yielded far better results than they would have expected. And according to me, this is the space that will see probably significant M&A activity even after the first dozen have wound their way into a resolution. It's basically going to be driven by just the thought of having an up-and-coming, ongoing manufacturing activity in India, which otherwise, with the permissions that you require, the environmental clearances, all the PILs that are filed, the socio-economic studies that have to take place, it's far too painful.
Right. And what do you think about Sashakt? How far will that go in resolving the issues?
So I think the Sashakt program has to play itself out, and it is really an interesting one because what it essentially does is to get the major banks, and for that read State Bank of India, to really take the lead in terms of trying to find a binary solution outside the Insolvency and Bankruptcy Code for a period of 6 months.
All right, with that, we will wrap up on this edition of Power Breakfast, but you stay tuned to CNBC TV 18. Bazaar Morning Call comes up next.